On the last business day of the month, the Federal Reserve Bank of New York surveys a bunch of banks about their implied volatility rates on currencies. So, and then ranks them, which you can get access to, by the way, at newyorkfed.org. In fact, I got to tell you, there's a lot of great information about the Federal Reserve that you can subscribe to and get access to every day in your email if you'd like to. It's one of the best websites I have found for getting a little bit of insight into what's going on with interest rates, what's the Fed doing. And as you can see, I took note of this. On the last day of the month, they released the average rates that came out of this survey, and the balance has shifted. So it used to be that the Aussie was the leader, and now we get the franc and the yen that are both popped up their volatility rates. So their implied volatility rates are the highest. What does that mean? Well, implied volatility means a lot of things, but it's a component of derivatives pricing, and in many ways, it represents what traders' expectations are about volatility for the near future. So in this case, what's going on in the week. And so we're looking at this from the perspective of, well, where should we be expecting volatility, or where might we get these feedback loops with stops being run, things like that. And right now, what we're hearing is that we've got a real cluster of volatility in the yen and the franc. We still have a little bit here piling up on the CAD and the Aussie, those commodity currencies. Not a big surprise, frankly. Not a big surprise at all. So it's interesting to see where institutional investors are really putting the most risk, which right now I mentioned yesterday in the pairs video that we know that there's a lot of risk clustered up in the yen. So it's something that we pay a lot of attention to, and I find this report actually to be quite useful. So how might we take advantage of that information? Well, there are a couple of things we can do. So right now I'm looking at a chart of the dollar yen. We're against resistance still, so we have not moved off of this resistance level. We've been bumping up a couple of times already in May, and on Friday we didn't make any progress, so we're still there. Volatility increases the premium that you pay for an options trade because the likelihood of that option moving a lot is higher than it would be otherwise. So, or traders expect that the probability to be higher. So they increase the premium. However, it also increases the probability, or the probability is a little higher that the market's going to move a lot. So it's one of these things you gotta think about. Well, why is the premium higher? And how that information is useful is that we can start to look at, well, the market's been channeling here for about a month, between 105.50 and about 102.50. Well, it certainly can't stay range bound forever, and this may be an opportunity to buy a straddle, something that's a little bit more market neutral to take advantage of that movement. See if we can buy something on its way just before the breakout. We're going to lose the one side of the transaction, but the other side is, of course, going to rally. And that's a particular strategy that I talk about quite a bit because, from a speculator's point of view, it's expensive, but it offers kind of the best of both worlds: unlimited profitability on both sides of the market for a fairly expensive premium up front. But of course, the probability of a total loss is also extremely low. So small losses, very frequent. Big wins, very infrequent, but you kind of balance those two out. So it's food for thought as far as taking advantage of that volatility. That's where traders are expecting a lot of it, which means that they're going to have a lot of protection in there. A stop run, we all know. If the market runs up, we're going to see a lot of the short stops getting hit. That feeds back on itself because how does that stop get hit? It turns into buy orders. So those traders start unwinding their short positions, gets into the market and starts driving the prices up, and we see these big moves like we saw back in March and February. Another way in which this information is useful, so we've got a similar situation here with the franc, where we're just coming up against this consolidation level. I'm not drawing a particular resistance level per se here, just marking where the market has come once, twice, came darn close yesterday, and is beginning to just peel off here again. Implied volatility rates on the franc are very high. In fact, are more or less tied with the yen for the highest in the short term, currently based on this survey of institutions. So another takeaway here is that institutions are getting ready for a transition in the market. Now, if that's the case, we may see a breakout of this pattern that we've been seeing over the last year or so, where the market begins to plunge, gets a little rally, plunges, rallies, plunges, rallies. We're in a little. Is this plunge right now going to continue? We're going to see more, even getting down below parity. That's a really good question. Once again, another opportunity for a straddle. Prices are going to be high, but also, as traders are getting ready for transitions in the market, the likelihood of a big move one direction or the other becomes very high. So it's a great way to take advantage of that kind of opportunity. The other takeaway here as we head into the weekend and get ready for the next week is that not just are there trading opportunities that are revealed in that information, but there is risk information revealed. So it helps us to understand which currency pairs is there the most chance for some volatility in the near term, because that volatility is just as likely to be working against our positions as it is for it. So it's a way for us to isolate those currencies that have a real high propensity in the short term to experience some volatility, and it helps us isolate those that we may need to consider perhaps taking some profits off the table on kind of an extreme view, or if you're longer term trend trader, or potentially just applying some hedge. So for example here, a dollar franc long position, if we're trying to take advantage of the recent normalization in the risk environment, the credit market, etc. Perhaps we're stepping into the dollar franc to the long side. Well, this may be an opportunity to buy an out-of-the-money put. So we're buying a little bit of protection. If the market were to collapse, that's going to really curb those losses without creating the danger of a whipsaw like a stop loss would or something like that. That's a very effective strategy for a longer-term trader where you can afford to take that kind of risk management approach rather than an all-or-nothing stop loss limit bracket order type of approach.